Opendoor Technologies is currently trading at $5.22, reflecting a downward intraday move of 3.87% as of April 24, 2026. While a nearly 4% slide might suggest a routine cooling off after recent activity, the underlying reality is far more interesting than a simple price dip. Most investors look at Opendoor and see a company struggling with the friction of the housing market, but the immediate insight here is the massive shift in how the company is engaging its backers. In about 2 weeks, on May 7th, Opendoor is ditching the traditional dry corporate conference call in favor of an interactive financial open house. This isn't just a stylistic change, it's a strategic move to leverage platforms like Robinhood and YouTube to speak directly to retail investors. By allowing shareholders to upvote questions via Say Technologies, they are effectively turning their earnings report into a town hall. This creates a curiosity loop. Why is a company that is still fighting for consistent profitability choosing this specific moment to become the most transparent player in the iBuying space? Usually, high transparency follows high success, but here it's being used as a tool to maintain trust while the business model itself is being stress-tested by a stabilizing yet expensive mortgage environment. The common expectation for Opendoor has always been that it lives and dies by the interest rate. The logic is simple. When rates go up, the housing market freezes, and Opendoor gets stuck with stale inventory that it can't move without taking a haircut. When rates go down, the floodgates open. However, the reality of the current market in April 2026 is that we are in a higher-for-longer stabilization phase, where mortgage rates are settling between 4.5% and 5%. The narrative that Opendoor is just a bet on the Fed is starting to crumble. Instead, the real story is their leaner infrastructure move. They have been quietly simplifying their tech stack and integrating their checkout and mortgage products to squeeze more margin out of every transaction. If you look at the recent trading volume, institutional activity is showing a fascinating split. While some larger funds have trimmed positions, we are seeing significant accumulation from players who treat this like a logistics company rather than a real estate firm. The expectation was a bounce back to double digits quickly, but the reality is a slow, methodical grind as the company tries to prove it can be a toll booth for home sales rather than a speculative house flipper. Focusing on the recent stock movement, the 3.87% drop today followed a pivot top on April 21st, where the stock hit a local peak before facing resistance near $5.26. We are seeing a classic battle between the short-term and long-term moving averages. The short-term average is currently issuing a sell signal, but the long-term average is still providing a baseline of support around the $4.95 mark. This volatility, roughly 8.8% between the day's high and low, is exactly why the stock is still categorized as high risk. Yet, the institutional inflow over the last 12 months has been over $1.2 billion, compared to just $300 million in outflows. That is a massive disparity. It suggests that while retail traders might be getting spooked by daily swings, the smart money is looking at the 2026 housing forecast, which predicts steady house price growth of about 2.4% to 2.9% annually. This kind of predictable environment is actually better for Opendoor than a wild boom, because it allows their pricing algorithms to work with higher precision and lower risk of a sudden market crash. To understand why the price is moving this way today, you have to look at the macroeconomic pressure of April 2026. Inflation is finally hitting the 2% target, but the labor market remains tight, meaning the cost of home renovations and labor, a key expense for Opendoor, is not falling as fast as home prices are stabilizing. This creates a margin squeeze reality that contradicts the expectation of a quick path to profitability. Investors are watching the resale velocity closely. If Opendoor can't turn a house in under 90 days, the holding costs start eating the profit alive. Recent reports indicate they are making progress on this front, but the market is demanding perfection. This tension is why the stock is currently a hold for many analysts, even as they acknowledge the potential of the iBuying model. It's a game of who can last the longest in a low inventory world. Now, let's take a step back and look at what Opendoor Technologies actually does for those who might be new to the ticker. At its core, Opendoor is the pioneer of the iBuying model. They use data and algorithms to provide homeowners with a near-instant cash offer for their homes, taking the uncertainty and months-long waiting period out of the traditional selling process. They make their profit through a combination of service fees, usually around 5 to 6%, and the difference between what they buy the house for and what they sell it for after making minor repairs. In the past, specifically during the post-2020 boom, they grew too fast and bought homes at the top of the market, leading to massive losses when the market cooled. That past performance still haunts the stock's valuation today. They've spent the last 2 years pivoting towards a capital-light model, focusing more on partnerships and a marketplace where they can connect buyers and sellers without necessarily holding the entire risk on their own balance sheet. The business model has also expanded into integrated services. When you sell to Opendoor, they want you to use Opendoor Home Loans and Opendoor Insurance. This is the same strategy used by firms like Fidelity or Charles Schwab, where the goal is to capture the entire life cycle of the customer's financial transaction. By being the one-stop shop for the largest purchase of a person's life, they hope to build a moat that purely digital competitors can't touch. We've seen this work in other sectors. Look at how the Robinhood app or SoFi Invest integrated multiple financial products to keep users within their ecosystem. Opendoor is essentially trying to do that for the residential real estate market. They want to be the Amazon of houses, where a transaction that used to take 6 months now takes 6 clicks. Looking ahead, the future outlook for Opendoor hinges on a few specific catalysts. First is the May 7th earnings report. If they can show that their financial open house is more than just a PR stunt and actually reveals a path to JAP profitability by the end of 2026, the stock could easily break through the $6.55 resistance level indicated by recent double bottom formations. The risk, of course, is the expectations gap. If the market expects a revolutionary update and gets a standard "we are making progress" message, the $4.95 support level will likely be tested again. There is also the legislative angle. Many are watching for any government intervention in the housing market to increase inventory, such as tax credits for sellers. Before we continue with the final outlook, I want to hear from you. Comment below how many shares of Opendoor you currently hold, or if you're waiting for it to dip below 5 before you buy in. Are you a believer in the iBuying model, or do you think the traditional real estate agent is here to stay? The reality of 2026 is that the real estate market is becoming more professionalized. Individual brokerage accounts and online investing platforms have made it easier for the average person to bet on the housing market without buying a physical house. Whether it's through REITs or stocks like Open, the barrier to entry is gone. But with that ease comes higher volatility. Opendoor's survival depends on its ability to manage its inventory of homes like a retail company manages its inventory of shoes. If they can maintain a lean infrastructure and continue to integrate their mortgage and title services, they become a high-margin tech company. If they fail, they remain a high-debt real estate holding company. To summarize the central insights of today's analysis, the expectation for Opendoor was a simple reaction to interest rates, but the reality is a complex restructuring of how the company interacts with investors and handles its margins. The 3.87% drop today is a short-term tremor in what appears to be a larger effort to stabilize the business model before the next housing cycle. Institutional players like Vanguard and BlackRock remain heavily involved, signaling that there is still a long-term belief in the scale of this project. However, the high daily volatility and the sell signal from the short-term moving average suggest that caution is warranted for anyone looking for a get-rich-quick play. Opendoor is a play on the modernization of the most stagnant industry in America. It's a bet on the idea that the smart friend in the room eventually wins because they have the best data. Whether $5.22 is a bargain or a trap depends entirely on your timeline and your belief in their ability to execute that open house transparency. The contrast between the market's nervous narrative and the company's steady accumulation of capital and tech integration is where the real opportunity lies. We will know a lot more on May 7th, but for now, the stock remains a high-stakes example of expectation versus reality in the 2026 economy. Maintain your discipline, watch the $4.95 support level, and stay tuned as we track how this interactive shift changes the game for retail traders in the coming weeks. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video? Comment your thoughts. Unshare with your friends. Subscribe for more updates.